there's a lot of news. I'm not sure if you guys had the TV on yesterday, but with the Fed hiking the Fed funds rate again, they did a 75 basis point hike, which the more that they do to fight inflation, which includes hiking that Fed funds rate, the better it is for mortgage rates. But what we're seeing right now is rates actually got worse yesterday. And so that's going to be part of the conversation. And then I want to share a couple of slides too. So basically, they said inflation's still on the rise, and they projected the amount that they're going to hike rates before the end of the year higher than they said previously. So it was a really tough day in the market yesterday. Just to give you guys some context, a par rate, meaning no points to buy down the interest rate, on a conventional loan with 5% down, 740 credit score, is at 7%.
Whoa.
Wow.
Yeah, at 7%. So a majority of what we're doing right now is typically we're quoting rates with points. So like with some programs, when we go to price loans, and this goes for lenders across the board, a lot of loan programs, you can't even get a par rate. So what that means is no matter what, there's going to be a cost or points that show up on the loan estimate. So I think it's really, really important right now. And I've been saying this for a while. It's like more important than ever to know our numbers and to be able to present the data to our clients in a way that they can digest it, and also explain exactly like what the climate is today and what the climate's going to be moving forward. So if you guys do have clients that are pre-approved and shopping right now, I would encourage you to reach out to that loan officer before the weekend and just say, hey, I know the Fed hiked rates. It wasn't good for interest rates. We're up again. Does this affect our pre-approval at all? And then additionally, as part of my professional presentation for clients that I'm going through, number one, I'm making an effort to get face-to-face with every single client that I can, just because these concepts and the numbers are much easier to explain in person, right? When you're talking about points and fees and everything over the phone, it's really, really difficult. So that's one thing that I'm working on. But additionally, if a loan officer is just saying, hey, here's what you're pre-approved for, here's what the interest rate is, here's what the payment is, that could be very discouraging, because to be completely honest, things are expensive right now, right? So like the cost of groceries and gas and everything is high. Well, with the high interest rates, mortgage payments are really high too. So I think it's important that regardless of who you're working with on the finance side, that person has to be giving the client a few different examples, meaning, here's a rate without points, and then maybe giving a buy down example so that we can illustrate to people what's possible. Like for instance, getting a seller credit to buy down the interest rate. That's really important for people to understand that that's possible, right? Instead of just getting a quote, looking at the payment and just being shocked and then just getting discouraged, right? So that's one thing that I'm doing for every client, is giving that presentation. I just had a transaction close in Shingle Springs on Monday, and this guy actually decided to spend $20,000 of his down payment. He put it towards buying down the rate, and he got a 4.875% interest rate, which saved him like $300-400 over the alternative. So again, just illustrating that for people is super important. And I want to show you. So just to recap, when the Fed hikes the Fed funds rate, it affects like credit card rates, home equity lines of credit. Those are dependent on prime rate, so it affects those. But the main goal of hiking that rate is really to make the cost of businesses borrowing money more expensive. And so the economic effect of that is basically they're trying to, I don't want to use the word crush, but they're trying to discourage or take away demand for goods and services so that people stop spending money. And they said a couple times, Chairman Powell, he's using the word pain, and he's used that for a couple meetings in a row now. And essentially what that means is things are going to become more expensive for businesses. And ultimately, what they're projecting is for the unemployment rate to go up. So I made a couple notes. So their target or their estimates for the unemployment rate by the end of the year is 3.8%. And the unemployment rate estimates for next year is 4.4%. And I wanted to share a slide because we can actually equate the unemployment rate to mortgage rates and recession and things like that. So let me share my screen real quick. Okay, so one might think that you would have a recession when unemployment is at its highest, right? That just kind of makes sense. When actually a recession happens when the unemployment rate hits an all-time low and then bounces. So this chart right here, it goes back to 1950s. The white line represents the unemployment rate, and the shaded area of each section represents a recession. And so you can see without a doubt, when the unemployment starts to bounce higher, that's when the recessions happen. So you can see 2008, that was a long period of recession. This slide is actually out of date. I think it came out, gosh, I want to say it might be from like 2019. But at that time, or no, this was 2021, because you can see at the very end of the chart, 2020, we had a very small recession at the beginning of COVID, and that's when the unemployment rate really bounced up, right? So looking more towards today, we're at that like all-time low. So the reason why I bring that up is it's important because this chart correlates mortgage rates to a recession. So every time we enter a recession, mortgage rates drop. So again, this goes back to 1980. So during that recession, rates went from 16 to 11.75. The following recession went from 18 to 13. In 91, 11 to 8.75. 2002, 7.3 to 6.7. 2008, 6% down to 4.875. And then during COVID, 3.75 to 2.75. So the reason why I'm going into this data is I'm sharing this with our clients because there is light at the end of the tunnel when it comes to interest rates. So again, when I'm having conversations with people, I think there is a good opportunity because people have negotiating power right now. Not the ideal market for a seller necessarily, but because this demand's kind of been curbed, I believe there is good opportunity for people to get into homes. And then also kind of correlating that to what the Fed's saying, they're saying that basically we're going to be in a recession as early as Q1 of next year. So this is my personal opinion, but I believe that rates will come down probably in the first or second quarter of next year, which is encouraging. Another thing that the Fed said in the meeting yesterday. So is anyone familiar with with how the Fed was purchasing mortgage-backed securities? Or do you understand how that works?
A little
No,
bit.
I don't.
A little.
Okay, so ultimately, when we do a loan, each mortgage company puts hundreds and thousands of loans together and they sell them, and they're either securitized by somebody on Wall Street, Fannie Mae, Freddie Mac. So they package them into a mortgage-backed security and they sell that security. So basically, during COVID, and part of the reason that interest rates were so low is the United States government was purchasing these securities, and they were purchasing them anywhere between 60 and like $120 billion a month. And so they have a lot of these securities on their balance sheet, and eventually they're going to have to sell those. And so what they said yesterday was they don't have on their radar in anywhere near in the future that they are going to start selling those, which is good, because if they did, things would get a lot worse for interest rates. So that was a positive thing they said. So the fact that they're going to hold on to those securities and they're raising rates and we're looking forward to that recession, I think interest rates are going to come back down in the first half of next year. So again, I think this is really important data to share with clients. One, because they could possibly get into a home for, under list price, or negotiate some type of credit to buy their rate down. And then looking forward to the future, they would have an opportunity to refinance at a lower rate to get their payments down. So I know that was a lot of data that I just threw at you. Does anyone have any questions about that?
No, that sounds like a good plan.
Yeah, it does sound like a good plan. I mean, so again, rates are high, payments are expensive. So I think it's just really important for us as professionals to focus on educating people and like letting them know where everything's at. And additionally, like I said, if you've had someone pre-approved, it's important to get that update going into the weekend, just to make sure that they're still qualified for what they thought they were. And again, as part of my process, so every time we have a pre-approved client, because properties are sitting on the market longer, buyers are allowed to be a little bit more picky right now. I'm calling all of our pre-approvals each week to educate them on what's happening in the market and kind of keep their head in the game, if you will. So I think that's really important. It's been an interesting market the last few years for mortgage and real estate. Specifically mortgage, we kind of went from being more service-based. I mean, interest rates were so low, everybody and their mom was refinancing. So, we're coming back to where we have to be salespeople, right? Like first and foremost, that's what we need to do. And so I just want to share value and data with you guys to, help educate our clients. So I talked about the unemployment rate. The Fed also said that there are more rate hikes to come. So they're probably going to have, I think it was 150 more basis points added to the Fed funds rate by the end of the year. So that could mean 2 more rate hikes of 75 like they did yesterday. It could be, 100 basis points one meeting and 50 basis points the next. But the bottom line is inflation is not under control yet. And so they're going to keep hiking the rate to get us there. Like they said, it is going to be painful. I think there will be some job loss and some slowdown in the economy. But again, that's going to mean lower interest rates. So, I think as that happens, there's going to be new opportunities. when the rates do go down, I think there's going to be a lot more buyers that come back into the market, which is encouraging. And I don't know what percentage this is going to make up of overall sales and business. I don't really think we're going to have short sales and foreclosures per se, but there might be listing opportunities that come up if people do experience, job loss or loss in income. I think, Janet, you and I have had a client recently that is a fixed income person that's downsizing. So I think those opportunities will continue, and the demand, like as far as how many households we have and how much inventory we have, I'm sure you guys are seeing, I think there's more inventory coming on the MLS. Things are staying for a bit longer, but still there's so much demand for housing. It's, I don't think the appreciation or that demand is going to go away anytime soon. Gosh, I talked to a client yesterday, a potential buyer, and she's paying $3,000 a month for a house in Roseville. And so that's definitely a mortgage payment. So the stats on year over year rents going up, on average, rents are up 12% year over year. So that's $120 a month for every $1,000 on your rent. So I think we're going to be a strong market, but definitely important to educate clients on what's going on with the rates right now.
For sure.
Do you guys have any questions or comments about that, or what are you guys seeing in the market as far as inventory and everything?
Yeah, not quite as much inventory for sure. That supply and demand thing, that this demand is still there because the supply isn't there. But
Yeah.
the houses that aren't priced right, they're sitting, and there are price reductions. I'm seeing more price reductions.
Yeah, me too.
So yeah,
Still, because I know Ryan Lundquist came out with that article, I think it was in July, and it was like June to July, like 49% of listings had price reductions in Sac County.
Oh, wow.
I met with an agent the other day. He had 2 listings come on, and he did 1 weekend of open houses and did price reductions on both, like immediately. And one was pretty substantial. I think it went on at $799, and it was semi-updated in El Dorado Hills, but there was like a sliding glass door and then a large dining room window that was like the older style that needed to be replaced. And so the feedback he got from the open house was, hey, whoever buys this still has to do some upgrades. So I think it's been the trend for a while that like a squared away turnkey home that doesn't have a bunch of projects, it seems like those ones are selling quickly, right? And maybe even multiple offers still.
Yeah.
I think people need to, we need to stop doing this whole 6-month comp thing now, because that's where the sellers are, they get their hopes up, but it's like really the last 2 months maybe would be more accurate, I would say.
Yeah.
Because it changed so fast. I mean, the when rates really went up, I think it was early August was like the big jump. But yeah, I agree with that. And like some of the appraisals that we've been seeing, Rachel, you and I had that one that came in over 100,000.
Yeah.
And thinking about it, I mean, 6 months ago, things were going way over list. So that's a comparable sale at that price.
But there's no way it would sell for that right now.
Yeah, exactly. So it's kind of interesting thinking about those appraisals and how that's going to stabilize values and kind of reel things back in. Yeah.
Got to get crafty, creative.
Yeah, definitely have to be creative. And like I said, I mean, it's just super important. I understand that, if if an agent sends me a lead, basically your paycheck is in my hands, right? So I'm just doing the best that I can to really educate people. I think it's really important to illustrate that buy down concept and show them, hey, I know you've heard on the news, the 30-year fixed average rate in the country is like 6.8% right now. Here's how we can get you a lower interest rate and keep your payments more affordable. And I think that helps out as well when they're looking at homes and shopping, because, and correct me if I'm wrong on this, it seems like the buyers right now are almost expecting to get a deal.
Yeah.
So like right out of the gate, they're saying, well, let's offer 50,000 under list. Right.
Oh, yeah.
Whereas doing something like that, I mean, it might not be justified and you might piss off the other agent, but spending some money with a seller credit versus just lowballing the offer, oftentimes will actually save them more on their monthly payment. So
Yeah.
it's just super important to educate people on those concepts and everything. So if you guys have, like, if you have a listing that comes up at a certain price point and you want to see examples of that, please let me know, because I can put numbers together and, put them in a way that we can present them. I'm also always willing to do Zoom call appointments. And like I said, my number one effort right now is to get people in the office face to face, just so we can like really get into the numbers so they fully understand what the opportunities are right now.